Okay, let's go ahead and work through some example problems from chapter 2. This chapter is introducing you to the debit credit system, which is how we record business transactions into the accounting system to tell the accounting system how the transactions affected the different accounts. The best thing you can do is to have some type of piece of paper or a cheat sheet where you have a diagram that looks something like this. You have the different types of accounts, which side the normal balance is on, whether it's on the debit or the credit side, along with how debits and credits impact those accounts. Which side increases it, which side decreases it. Have this piece of paper in front of you. You're going to refer to it a lot as you learn this system. I promise you that eventually you won't need this little cheat sheet, but you will need it at least for the first 3, 4, or 5 chapters. Okay, so looking at the in-class exercises or the example problems, the first one we're going to look at are transactions for this company, the Mercado, for June 2010. This is the very first month of the company's operations. We are going to prepare journal entries. The journal entries are prepared in the general journal, which is the original book of entry into the accounting system. What we're going to do is we're going to tell the accounting system what accounts need to change as a result of the business transaction. For example, the first one, company purchased equipment on account for $3,000. We know that 2 accounts are affected. Equipment, asset, increases because equipment was purchased. On account means that liabilities increased as well. We need to increase the asset equipment account, and we need to increase the liability accounts payable account. Going to what we would call our general journal, we are going to prepare a journal entry in good form. Journal entry in good form will always list the account being debited first, followed by the account being credited. Okay? Every journal entry has to have at least one debit and at least one credit. Total dollar amount of debits in every journal entry has to equal the total dollar amount of credits. Think of every journal entry as a little self-balancing entity, okay? Because this company's equipment increased, we know equipment is an asset. Assets have a balance on the debit side. To increase an asset account, we debit it. So we are going to show the account being debited first. We are going to debit it $3,000 for the amount we are increasing it. We are also increasing a liability account, accounts payable. Liability accounts have a credit balance. To increase them, we credit. We are going to credit accounts payable to increase it $3,000. This journal entry is complete. We have at least one account debited. We have at least one account credited. Debited accounts are first, and then any accounts being credited are afterwards and indented. Indented to show that it kind of differentiate it from the debit accounts. Total dollar amount of debits equal the total dollar amount of credits. Okay. The second transaction, billed customers $5,000 for services performed. When we bill customers for services performed, it means we have provided the service, but we haven't yet been paid for it yet. We have only billed them. Thus, we are going to record an increase to our accounts receivable because customers owe us more. We're increasing our receivables. Accounts receivable is an asset. To increase it, we will debit it. So we are going to be debiting accounts receivable. That account will be first in our journal entry. The other account affected are revenues. The company has earned revenues because the services have been performed. Revenues are increasing. Revenues have a credit balance. To increase the revenue account, we are going to credit it. So here is our credit to service revenue. This journal entry is in good form and it is complete. The account being debited is first. The account being credited is after. Total dollar amount of debits equal the total dollar amount of credits. And there is at least one account debited and at least one account credited. Next transaction, made a payment of $1,500 on account for the equipment purchased earlier in the month. Remember up here, we had purchased equipment on account. At that time, we recorded into the accounting system an increase to equipment and an increase to accounts payable. We are now paying off that liability. Because we are making a payment, liability is decreasing. Liabilities have a credit balance. To decrease the liability, we will debit it. Thus, to decrease accounts payable, decrease the liability, we're going to debit it for $1,500. That liability is decreasing because we paid $1,500. If we paid, it means we used up some of our cash. Cash is an asset. To decrease it, we will credit. Thus, our account being credited in this journal entry is a credit to cash of $1,500. This journal entry is complete. Accounts being debited first, then the accounts being credited. There is at least one account debited and at least one account credited. Total dollar amount of debits equals total dollar amount of credits. Finally, we collected $2,900 on customer accounts. This means that we had previously recorded accounts receivable for providing services in the past to customers on account. Now some of the customers are paying what they owe us. We collected $2,900, which means we collected cash. Cash is an asset. To increase it, we debit it. We'll debit the cash account for $2,900 for the amount we increased in cash. We collected because we had accounts receivable from the customers. However, if the customers paid us, they no longer owe us that amount. That means our accounts receivable have decreased. That means we will be crediting accounts receivable to decrease it. Accounts receivable is an asset. It has a normal debit balance. To decrease it, we will credit. Here is our journal entry. We have at least one account debited, at least one account credited. Debits are first, and then the accounts being credited. Total debits equal total credits. Hopefully this exercise is helping you get the feel of a properly formatted journal entry, and we will proceed on with another example. All right, I took away the debit credit cheat sheet, so hopefully you have one in front of you now to refer to. For the second problem, we're working with Gordon Services. It was formed on June 1st of 2013. The following transactions took place during that first month of operations in June. Jim Gordon invested $50,000 cash in the company as its sole owner. From the company's perspective, the company received $50,000 cash, means their cash increased. The owner invested, which means the owner's capital also increased. To increase cash, we will debit it. Cash is an asset. To increase, we debit. The owner's investments went up, which means the owner's capital account went up. We will credit Jim Gordon's capital account to increase it. To increase the capital account, we credit. The second transaction on June 2nd, or the second thing that happened. 2 employees were hired to work in the warehouse. They will be paid a salary of $2,800 per month. Now here, there is no exchange of resources. There was no transaction here. The only thing that happened was 2 employees were hired. They haven't earned anything because they haven't actually worked yet, so the company doesn't owe them anything. There is nothing to record in the general journal to get it into the accounting system because there was no business transaction. Remember, business transactions have to involve the exchange of resources. On June 5th, the company signed a 2-year rental agreement on a warehouse and paid $24,000 cash in advance for the first year. We are paying for the rental for the next year. We have not actually incurred any expense yet. We have prepaid for future rent costs. Remember, this is only June 5th. We are prepaying future rent. When we prepay a future expense, we are creating a new asset. This new asset will be used to cover our future rent cost. What we are doing is using cash, which is an asset, to create a new asset. That new asset is prepaid rent. We now have more prepaid rent. We are going to increase our asset to reflect the fact that we now have more prepaid rent asset available to us. To increase an asset, we debit it. So we are debiting prepaid rent, $24,000. We used cash to obtain the prepaid rent asset. Thus, cash is decreasing. Cash is an asset. To decrease cash, we will credit it. On June 8th, we purchased furniture and equipment costing $30,000. We paid cash of $10,000 and we'll pay the rest in 6 months. First things first, we purchase an asset. We have more asset. We need to increase our furniture and equipment asset because we now have more. To increase that asset, we debit it. So we will debit furniture and equipment. We used some cash to pay for that purchase. Cash needs to be decreased because we spent some of it. To decrease cash, we credit it. We also owe another $20,000, which means we have more liabilities now. Our liabilities are increasing. To increase our liabilities, we will credit them. We will credit accounts payable $20,000. Notice that in this journal entry, we have at least one account debited and at least one account credited. It's okay that we have 2 accounts credited because the total debits still equal the total credits. Okay, so this is kind of what we call a compound journal entry. There's more than one debit or more than one credit. On the 11th, we paid $1,800 cash for a 1-year insurance policy on the furniture and equipment. Here we are paying for a future insurance cost. Just like when we prepaid our rent, we are prepaying future insurance. We are creating a new asset. Just like when we prepaid rent, we are now creating a new asset for prepaid insurance. This asset will help us cover our insurance cost in the future. We have more prepaid insurance. We have more asset. We are going to increase prepaid insurance. Oops, sorry, I did not mean to do that. We're going to increase prepaid insurance with a debit. That's how we increase an asset, with a debit. We used cash to pay to create that asset. We're going to credit cash because cash needs to decrease. Cash was used. On the 14th, the company purchased basic office supplies for $500 in cash. Office supplies are an asset to the company. In order to increase the office supplies, because we now purchase more supplies, we need to debit it to increase an asset. Cash was used to purchase those office supplies. To decrease cash, an asset, we credit it. On the 15th, this time we purchased more office supplies, but we purchased them on account. We bought more office supplies. It is an asset, so we are increasing it with a debit. We haven't paid for that purchase yet. So we didn't spend cash. We now have more liabilities. To increase our liabilities, we need to credit accounts payable. Look at both of these transactions. They're pretty similar. In both transactions, we bought the asset. But in one, we paid cash right away, and the other one, we increased our liabilities because we purchased them on account. On the 18th, total revenues earned were $20,000. $8,000 of those revenues were paid in cash, the other $12,000 on account. This means we provided services to customers totaling $20,000. Of those services, $8,000 were paid to us in cash and $12,000 haven't yet paid. We have provided the service. We have earned the revenue. Regardless of whether we were paid or not, we record revenues when they are earned. We will record all $20,000 of revenues. We are increasing our revenue account because we have earned more revenues. In order to increase a revenue account, we credit it. So we will credit the service revenue account for the total amount of revenues earned. Cash will go up 20,000. Cash will go up 8,000. Cash is an asset. To increase cash, we debit it. The other 12,000 revenues earned that haven't yet been paid means the customers provided the service on account. The customers now owe us $12,000. We will record an increase to our asset, accounts receivable. This shows that customers now owe us an additional $12,000. Let me point something out here. This is another key concept. Notice that we recorded the revenues when they were earned, regardless of whether we were paid right away or whether we will be paid later. Record revenues at the time they are earned. On the 23rd, we paid $400 to suppliers for accounts payable due. Accounts payable reflect the amounts that we owe to others. They are our liability. We are paying off $400 of that liability. If we are paying off liabilities, our liabilities are decreasing. Accounts payable is the liability account we are paying off. To decrease the liability account, we debit it. So we will debit accounts payable to show that it has decreased. We've paid off some of what we owe. We used cash to pay off that liability. Cash is an asset, so to decrease it, we credit it. On the 26th, we received $3,000 from customers in payment of accounts receivable. Customers are paying off some of what they owe us. We have kept track of what is owed to us in an asset account titled Accounts Receivable. If customers are paying off what they owe us, our accounts receivable is decreasing. To decrease an asset account, we will credit it. We received cash when the customers paid off what they owe. Our cash is increasing. Cash is an asset. To increase an asset account, we debit it. On the 28th, we received utility bills in the amount of $200. We will pay these utility bills next month. If we received a utility bill, it means we have incurred a cost of doing business, a utility expense. We will pay this expense next month. However, just like with revenues, we record expenses as soon as they are incurred. That means we are going to go ahead and record the utility expense as soon as we have incurred it. To record an increase to our utility expense, we have incurred more expenses. We need to increase them. We will debit utility expense for $200. We are going to pay that expense next month, which means we have an increase to our liabilities. Our liabilities have gone up $200. To increase the liability account, we credit it. Another emphasis here. Just like we record revenues when they are earned, regardless of whether we actually get paid for them or not, we record expenses when they are incurred. We don't wait to pay them to record them. Okay, what you're learning is the accrual method of accounting. Record revenues when earned and expenses when incurred. The final transaction is we paid the monthly salaries of the 2 employees that we had hired. That total cost is $5,600. If we are paying the salaries, it means we have incurred the salaries expense. Our expenses are going up. To record an increase to an expense, we debit it. So we will debit salaries expense for the amount of the expense. We are actually paying that expense right away. We're not going to pay it later, we're paying it now. So we're using cash to pay that expense. We will credit cash to decrease that asset. All right, hopefully you're getting the hang of this debit and credit system. All right, what we have done so far in these example problems is we've looked at how to apply the debit credit system to transactions and prepare journal entries in proper form. Then we looked at preparing a whole bunch of journal entries for a company. When we prepare journal entries in a general journal, we are just telling the accounting system what accounts need to change. The next step in the accounting process is to take those journal entries from the general journal and post each debit and credit to the general ledger. The general ledger is think of it as the filing cabinet where the accounts are maintained, the account records, okay? So what we have here in this last problem is that next step in the accounting process. Here are transactions for the Liberty Bell store. These transactions were already prepared into journal entries in the general journal. Our job will be to now take each debit and credit from the general journal and post it to the general ledger. In other words, this journal entry is telling the accounting system accounts receivable need to be debited $3,400 because accounts receivable needs to be increased $3,400. But that account actually hasn't changed or been increased yet. In order to increase it, we need to post this debit to that account. So let's give it a try. General Journal tells us we need to debit accounts receivable for $3,400. I'm going to go from this General Journal, page 6. And I am going to find in the General Ledger the accounts receivable account. So here is the cash account, and here is the accounts receivable account. It is account number 112. On May 5th, we are bringing from General Journal, page 6, a debit of $3,400. We are posting that debit to the account in the General Ledger. That causes the balance in accounts receivable to increase to $3,400. To notate that debit has now been posted to the general ledger, we are going to take the account number of where it was posted back to the general journal. When we see this number in this reference column, it tells us that that debit has already been posted to account 1112 in the general ledger. This is called post-referencing. We can see what account the debit was posted to. If I were to look in the general ledger, I would see that that debit came from General Journal, page 6. In other words, it's cross-referencing back and forth. So no matter which side we start with, we can always trace where that transaction came from. We have now posted that debit to accounts receivable, and we have now caused that account balance to increase. The next line item in the general journal tells us to credit the service revenue account for $3,400. I will go to my general ledger. And I am going to look through here for the service revenue account. Here is the service revenue account. It is account 401. On May 5th, the general journal tells us from General Journal, page 6, to credit this account $3,400. Credits to a revenue account cause the balance to increase. So the balance is now $3,400 in that account. I will take my post reference of account 401 back to the general journal to indicate that that credit has now been posted. This journal entry has now been fully posted to the general ledger, and it is now recorded, causing those account balances to change as a result of the business transaction. The next thing we're going to do is go to the next line item in the general journal. This line is telling us to debit cash for $3,500. I will go to my general ledger, And I will find the cash account. On May 10th, from General Journal, page 6, we are debiting this account $3,500. Debits to asset accounts cause them to go up to $3,500. I'm going to take my post reference, what account I posted that debit to, back to the General Journal to indicate that that debit has now been posted. The next line item tells me to credit the service revenue account for $3,500. I go to my general ledger and I find my service revenue account. From May 10th, General Journal, page 6, I am crediting it $3,500, causing that balance to go from $3,400 up to $6,900. Credits increase the service revenue account. I will take my post reference back to my General Journal, showing that I have now posted that credit. Go to the next line item. This tells me to debit the supplies account for $400. I go to the General Ledger. I find the supplies account. From May 15th, General Journal, page 6, I am posting a debit. Supplies is an asset. A debit will increase the supply account, bringing it up to $400. Take my post reference, account 126, back to the General Journal to indicate that supplies has been debited $400. My next line item is to credit accounts payable for $400. I will go to the General Ledger. I will find accounts payable. On May 15th, from General Journal, page 6, I am crediting it $400. Brings its balance up to $400 because credits increase liability accounts. Take my account number where I posted to, back to the General Journal to document that I have now posted that credit, causing accounts payable to increase $400. Hopefully by now you're getting the hang of this posting process, so I am not going to go through the remainder of these transactions. Take a look at the example problem solutions, see if you can post the rest of these properly to the General Ledger. What will happen is at the end of the posting process, we will have taken all of the transactions for the month and updated all of the accounts in the General Ledger to reflect all of those transactions, leaving us with ending balances in all of these accounts. When we take the ending balances in all these accounts, after all of the transactions for the current accounting period have been posted, we want to make sure that the accounting system has stayed in balance, right? That our assets equal our liabilities in owner's equity accounts. The way we do that is preparing what's called a trial balance. And the only thing a trial balance does is it makes sure that all the accounts with debit balances equal all the accounts with credit balances. It's very simple to prepare the trial balance. We will just use out of the General Ledger the ending balances in all of our accounts. So cash has an ending balance of $600. When I take the cash balance to the trial balance, I will put the cash balance in the debit column. I will pick up every account's balance out of the General Ledger. Here's accounts receivable, ended with a balance of $2,000. Supplies ended with a balance of $400. Equipment ended with a balance of $2,000. Accounts payable ended with a balance of $200, so on and so forth. When I place those balances into the trial balance, I will be listing all of the accounts with debit balances. Those balances are listed in the debit column. Any accounts with a credit balance get listed in the credit column. When I add the debit account balances, they should equal the credit account balances. If I have debit balances equal credit imbalances, it means that my accounting system is in balance. This doesn't mean that I didn't make any errors. okay, I could have made an error somewhere where I increased an asset when I should have increased an expense, or I decreased a liability when I should have done something else. So I could have still made errors. All this tells me is that I am in balance. Okay. Hopefully this is helpful. Please reach out with questions if you have any, and give your homework a try. See how you do.